Alan Gold, and I'll be your host for today's webinar, which is the second in our global issues event called the Global Labor Market. And we're going to be talking today about whether there is a crisis in the making or is that crisis already here. I guess I should say good morning, good afternoon, and good evening for those of us who are scattered around the world, and we have quite an international crowd again today for this event. And we appreciate your participation and giving us some of your time today. A quick note on logistics, because there are so many people online and there is so much background noise from distraction, we've got your audio muted. If you'll note in the right-hand side, usually on your screen, you'll see a box, and one of the tabs will be questions. Please feel free to use that screen to ask any questions or make any comments. We'll be gathering them up and combining them with similar questions, and at the end of the session, we will be playing those back for response by ourselves or Richard Hastings, our guest speaker today. I also want to let you know that there will be a recording available of this presentation in a few short days, and we'll provide details and the link to that recording for those of you who participated in this event. Final logistical point is I want to let you know that we have an upcoming webinar on December 15th, which is both a look back on the performance of retail as an industry in 2010 and a look forward into 2011. And you'll be receiving invites for that as well as reminders, but you might jot that down and make a note for yourselves as well. So today we're going to talk about the global labor market. There'll be some practical sort of implications and considerations around these issues and as they apply to retailers and their suppliers. And then there'll be an open question and answer session following those two pieces of presentation, and we'll let us run as long as practical. So before we just jump in, I just want to provide a brief introduction to TradeStone, because I know from the registration list that there are a number of people who may not be fully familiar with who we are. Very simply, we enable retailers and their suppliers, brand manufacturers, to unify design, domestic and global sourcing, ordering, and the delivery of both private label and branded goods. We call that merchandise lifecycle management, and it's a concept of tying together in a logical, unified way the end-to-end processes involved in design to delivery. We believe that brings tremendous value to the retail supply chain, and we are very excited about being able to be part of this very vibrant industry. We are very much focused on retailers and the manufacturers. That is all that we do. We don't design jet airplanes. We don't design boats. We don't design submarines. We're all about retail, and we're about the merchandise that makes up a retailer's life's blood and the goods that the manufacturers provide them for resale. We've been recognized by IDC, by Gartner, by Wall Street, by the professional organization ARTS in their standards committees. And there'll be a very interesting announcement today out of RIS News around their 2010 Retail Solutions Leaderboard that I can't tell you the details of, but we're very pleased with how the results came out. And we have offices globally, Boston, Atlanta, London, Bangalore, and Hong Kong, specifically to support a very wide range of global customers and global brands that we have, each of whom are leaders in their respective areas and in their specific markets. Now, a quick word about this Global Issues series. We'd been over the past 6 months or so really looking hard at the issues that our prospects and customers have been talking to us about, the analysts have been asking us to address and asking our opinions on, and the commentary that's come out of people like Richard and his peers, some of the Wall Street analysts like a Deb Weinswig, and in particular some recent research done by RSR, a well-known retail analyst firm. And it occurred to us that many of the issues that were being identified as market challenges for the retail supply chain, finding and keeping dependable partners, the distribution of supply chains getting stretched very thin, reaction times that have been slowed up enough that there wasn't the ability to respond to a sudden global or climactic event. The whole idea of risk and managing that risk seemed to be a central theme. And frankly, nowhere in the world, other than potentially material shortages, is that risk greater than in the world of labor. And it's in some ways, from our perspective, while in some levels it's a very prominent problem, in other areas, in other ways, it's something that's kind of sneaking up on us because we've been so accustomed to, in essence, an unlimited supply of inexpensive labor in relatively stable parts of the world. And I think, as you'll hear from our featured guest today, that may not be the scenario as it genuinely exists. So with that, it's my pleasure to introduce our guest speaker today, Mr. Richard Hastings. Richard serves as a consumer strategist at investment bank Global Hunter Securities. He provides top-line views of major trends in the consumer universe, retailing, capital markets, foreign exchange, employment trends, real estate, construction, marketing, advertising. He's also an accomplished belly dancer and a ventriloquist. And he is also quite an expert on the global labor market and changing trends in material management and shortages. So with that, I can't think of anyone better to speak to this topic. And we're going to pass the ball on to Mr. Hastings and ask him to join us.
Thank you, Alan. That's funny that you mentioned that because I happen to be wearing my belly dancing outfit right now. And I felt that was okay since nobody could really see me. So I don't think there's any problem. Let's get our slideshow going over here. Push the F5 button is the secret. And let's get right into our material. And I'm delighted to be here. The subject that we are going to talk about is a structural problem. There are many qualitative issues here that are only slowly beginning to have some sort of a quantitative background. In other words, data on what seems to be happening is relatively difficult to put together, but the qualitative argument is easier to understand, and we're going to have a number of slides that attempt to look at the structure of the situation. I think that over the next approximately 15 months, more data will emerge that supports the structural change. Unfortunately, we are now going into a period where the great productivity population contribution, specifically from China, that culminated 25 years of change in how the developed, mature economies, especially the United States, managed cost of capital and inflation, seems to have reached a threshold, and we have now passed over into a new paradigm. Since we are very early into the new paradigm, it is a little bit difficult to quantify some of its characteristics. That being said, we will attempt to use some of the more rich data that exists on the job situation in the United States in order to extrapolate from that some of what's happening elsewhere. And we'll get into that after we talk about some of the qualitative and structural issues, and we'll spend a little bit more time on the U.S. situation, partially because the U.S. market is the largest consumer goods market in the world. Let's take a look at our situation today, keeping in mind that the glue that we have been using for many years probably isn't working anymore. Moving forward, we believe that policymakers globally, especially among those in the export emerging markets and in the mature, developed economies probably have tried to create a new type of global economy without the natural borders that we learned about in our school books when we were young, and that are very much associated with the older nation-state system that led up to World War II and, of course, changed significantly in the post-World War II environment. There are arguments that we could make that the post-World War II culture globally has come to an end, and we are now into a new period of history. So let's take a look at this slide and see if we can discuss this. And occasionally I'll read a little bit from the slides for those of you who are multitasking. The current crisis suggests that policymakers probably were looking for some sort of a borderless international commerce system. When I say borderless, I'll give you an example of what I mean. In the United States, if we look at imports and then we look at the relationship, especially with China, and then we look at trade flows between Japan, South Korea, the Asian giants, Taiwan, Hong Kong, Singapore, and then especially China, we can see that the way that we do trade with Asia and the way that Asia subsidizes U.S. Treasury debt seems to represent a borderless international system. Things like that typically would have occurred many decades ago with a more naturally prominent set of borders. And it has become difficult for some people to understand that perhaps we're operating in a borderless international system, and it really does help to explain some of the strange international finance mechanisms that frequently people don't like. So at the same time that we have this borderless system, we also have labor malabsorption. So I'm using a kind of a chemistry term to describe what's happening in labor, especially in the United States, and what I believe, of course, is happening significantly in Spain, where the unemployment rate is unusually high, in the Baltic states, Lithuania, and its neighbors, and it is starting to crop up as a problem in other European states outside of the core, which, of course, the core being Germany, which is extremely efficient, and which, ironically, still has some of the older nation-state concepts regarding finance, and that's part of the reason why they're in better shape than a lot of other places, and why they have so much more weight and influence in the European system and globally as well. We are now moving into a strange period where you have labor malabsorption globally. The United States specifically has a significant problem with that, concurrent to austerity. And we are now living in what some call the new austerity. And since that term is not being used exclusively by anybody yet, we'll go ahead and we'll use it as if we've gotten comfortable using it ourselves. So we have labor malabsorption as a persistent chronic problem, concurrent to the new austerity, which is an outcome of the global debt crises. And when you have austerity, it makes it harder to resolve some of the features of the labor crisis. State budget crises in the USA happen to resemble some of the labor and debt crises over in the Eurozone. And you can see in the news just recently, especially what we have seen over there in the case of Ireland, you can see that the austerity measures being requested upon Ireland would make it difficult for Ireland to employ a lot more people and to be competitive in luring jobs into Ireland in order to reduce unemployment. The connection between debt, austerity, unemployment, and taxes will become clearer in a rather complex schematic diagram that we'll see in a few slides. Global austerity is spreading, and it makes it harder to subsidize unemployment benefits. Specifically, let's look at the case in the United States, where it is getting harder to vote successfully the passing of extended unemployment benefits for those that have been unemployed for long periods so that they may continue to have benefits. The popularity regarding austerity, which is characterized by the Tea Party in the United States, is influencing the Republican Party, which now has the vast majority in the House of Representatives with significant capabilities of permitting and not permitting funding for many different things, thus providing the platform for new austerity to spread from the House of Representatives back through the Senate and putting pressure on the executive branch in the United States. All of that represents an enormous change in the paradigm in the U.S. Meanwhile, workers in Asia, China especially, are demanding better conditions and wages, potentially sending inflation back to the United States, which would intensify the effects from state austerity programs. Therefore, a state that has an austerity culture because of a very, very lopsided state budget situation would find itself having more difficulty subsidizing labor and benefits, especially at the government level. And we're starting to hear more talk about states thinking about cutting back on how much they will provide in different kinds of long-term benefits for those who worked in state jobs. So we are rapidly entering into a new culture, which is all very much associated with the world without borders and the international debt financing system that came into focus, especially in about 1981 and 1982, and we'll take a look at some of that momentarily as well. So now that we've defined the basic scenario, we are looking at an exciting subject and a grim subject at the same time. For those of us that are in the supply chain for consumer goods, many products remain labor intensive. Gluing together sneakers has not yet been fully roboticized. Therefore, we do have to be concerned about what does it mean when you already have the shoe tax on something that's labor intensive and the capability of the planet to produce cheap labor to glue together footwear looks like it has come to some sort of a conclusion, and therefore if you already have a tax condition on a specific type of product concurrent to inflation coming from unit labor costs, what does that mean for the future placement of the product and for product promotion and pricing and volume going forward? All of this sets in motion everything associated with collaboration, planning, and forecasting. Moving along to slide number 5, let's take a look at the same qualitative arguments further. So now we're taking a look at foreign currency exchange, which we call Forex, trade, and inflation and labor. Over there on the left-hand side, emerging markets are characterized by lower-level manufacturing, agricultural exports, forestry as well, and minerals extraction are typically very valuable occupations in emerging markets. Meanwhile, on the other side, to the right of that diagram, mature economies tend to like to hoard and keep good control over their technology jobs, healthcare, education, and other value-added occupations. For example, in the United States, politics. Looking at the emerging markets further, population growth is typically much faster than in the mature economies, and population growth is a source of productivity for the mature economies, but only if global trade retains its current borderless shape. Very important point to think about. Now, inflation remains low in the mature economies only if emerging market productivity remains in place as we've known it. And that means their population growth has to be significantly faster than ours. It has to contribute to a sequential yet very mild little decrease in unit labor costs over time. If you have the population growth and you start to have unit labor costs, then we will still have the question of how do we get those unit labor costs down, and therefore the mature economies would seek to find production in global markets where there's a better equilibrium of population growth and sequential historical lower unit labor costs. Now, tax collections in many mature economies are starting to fall behind the rate of new debt issue. That means that the rate at which the tax collections are taking place is falling behind the rate at which the debt is being sold. And we'll see a very frightening diagram about that in just a little bit. Moving along to slide number 6, the qualitative conversation regarding China. We would tend to believe that the China miracle is something that occurs once every 200 years. We believe that this is not only something that would occur once every 25 years. If we look at the motivation of the population, the capabilities of the population, the type of literacy in many different fields of the population, and then the scale and size of the population, that makes the China contribution to global trade absolutely unique. And therefore, an attempt to see some sort of a comparison over the last 25 years is absurd, fails, and forces us to look for comparisons over much longer periods of time. If we attempt to look at it over a 100-year period, the United States, many, many decades ago, appears to have some comparison, but I would tend to argue that even here, the United States may have been a smaller phenomenon. China's contribution is possibly a 200-year event. Therefore, it is not going to be repeated anytime in the near future, and the impact from that is absolutely extraordinary. So China's contribution to global costs of capital and inflation, and therefore global trade and Forex, it's absolutely unique, and it really cannot be duplicated. So if we assume China's contribution has matured, then China's relative weight and impact on global trade is slowly diminishing. A new paradigm is therefore emerging. Let's talk a little bit about tax revenues and economic growth, Forex and trade on slide number 7. Everything in the borderless international system has to do with trade, and then trade has to do with Forex and the value of currencies and attempts to prevent currencies from spinning out of control. Unlike the stock market, where things are a little bit easier for some parties to make money on the upside and on the downside, put options and call options in Forex are not always an easy thing for everyone to do, and is definitely something for professionals only, and therefore massive fluctuations in Forex seem to have some sort of a benefit only for very experienced and highly qualified mathematical traders, leaving the potential for significant chaos to occur in global trade markets. It is a very dangerous and interesting subject, and that is part of the reason why the United States and China try to keep the Forex relationship between the dollar and the yuan relatively stable in order to maintain trade between the U.S. and China relatively stable as well. And after hearing what I just talked about, it should be rather obvious why we would want to keep it relatively stable. So, Forex and trade, you have economic growth, and then you've got tax revenues. Economic growth leads to cash, which is going to be available to pay taxes. Over there on the other side, tax revenues, higher taxes become a form of inflation. Forex and trade have a lot to do with credit and capital, the availability of credit and capital, and the costs and the availability of credit and capital. Forex and trade definitely have something to say about changing levels of taxes, which is a form of inflation, and are very sensitive to changing costs of credit and capital. Going down to the lower left-hand side on your screen, you can see that external debt, such as selling U.S. Treasury debt, is a source of external credit. Now, higher taxes require higher interest rates, and growth tends to reduce the risk and the cost of credit. So the more that you have growth, the more that it offsets the problems from higher taxes. So if you have a lot of debt being sold, if you sell a lot of debt, like we sell a lot of treasury debt, but your economy is growing, then it reduces the risk that interest rates would go up, and it tends to restrain the cost of capital. So you have to have a nice situation where if you want a lot more debt, then you also eventually have to have a lot more growth. That was the case in the early 1980s, and of course very much so in the 1990s, and is much less the case right now. On the right-hand side, you can also see that Forex and trade have to do with trade and tax revenues. The more trade occurs, the more freely that it occurs, the more tax revenues are collected and are available to pay for many different things and to subsidize many different types of things such as labor. Meanwhile, the other form of credit and capital is equity capital, such as stocks. And when you have good conditions in equity capital markets, it encourages investors to make investments into equity capital, and higher taxes at the same time would discourage equity investors, and it would increase the equity cost of capital. Therefore, good growth would restrain inflation and would encourage more investment into equity capital. And then finally, you would see better conditions in the private sector and privately held and publicly traded companies because of the proliferation of equity capital. So ideally, if you've got good growth, then inflation is down and you can sell more debt, and you have more investment into private industry, publicly traded and privately as well. If something rocks that complex boat, and we of course believe that it's rocking, then we have to believe that it's not as easy to invest into publicly traded and privately held firms, which are a source of employment, and those two things are also a source of tax collections, and tax collections become necessary in order to keep the cost of credit down, especially external credit in the form of treasury debt, or in the case of other countries, what's called sovereign debt. If something doesn't work quite right, and if the tax collections are not quite right, then the investment into private industry deteriorates, employment suffers, and concurrently the cost of issuing new debt may go up. Fortunately for the United States, we have a lot of strategic influence.
We're experiencing technical difficulty with our speaker. Please bear with us, and we'll have the seminar back on track in just a moment.
Alan, can you hear me now?
Yes, you're back. Thank you, Richard.
Okay. Alan, do you have any estimate about how much potential material we lost? Alan, can you hear me?
Yes, Richard, you can continue if you can hear us.
I can hear you. The question, Alan, was whether you felt that I was cut off for a longer period, or was it very short?
It was a very short period, just at the tail end of this slide.
Okay, so you were able to get something that told you that the audio was not moving through. Is that correct?
That's correct. You just dropped off. So
okay.
I think you can pick up where you left off.
Okay, very good. The essence of slide number 7 is that the irregular relationship between tax collections and debt that is issued starts to have an impact on employment, and we're starting to see that globally become an issue. While slide number 7 is a little bit more complicated, it does represent enough talking points to explain that we have moved into a new paradigm where we have an unreliable relationship between equity capital, external credit from sovereign debt issuance, and tax collections. Therefore, we are entering into a somewhat unstable period, and the impact on global labor is very significant. We do need to be very concerned about this and focused that this is the core of the problem globally. Moving along to slide number 8, I thought it would be very interesting to look at this comment from a working paper that came out of the BIS the Bank for International Settlements, earlier this year. And in March they said, quote, "It's essential that governments not be lulled into complacency by the ease with which they have financed their deficits thus far. In the aftermath of the financial crisis, the path of future output is likely to be permanently below where we thought it would be just several years ago. As a result, government revenues will be lower and expenditures higher, making consolidation even more difficult. But unless action is taken to place fiscal policy on a sustainable footing, these costs could easily rise sharply and suddenly," end quote. It's very interesting that their comments earlier in the year have been fully played out by the Greek sovereign debt crisis, by the Irish banking crisis. The Irish crisis right now is primarily a banking crisis and is not a sovereign debt crisis. Portugal is a little bit of both. Spain has a significant banking crisis waiting to come upon global markets next year. So therefore, the more ominous warnings coming out from this comment are already being played out fully in global capital markets. Moving along to slide number 9, let's get into the qualitative discussion about lower-level jobs. And lower-level jobs seem to be some sort of a hot potato. The qualitative discussion kind of goes like this. Countries export inflation, China, for example, they export inflation, and lower-level jobs in order to improve budgets and boost wealth. Countries export inflation. The United States, in this case, exports inflation to China and lower-level jobs to China in order to improve our budget and to improve our wealth. This reduces the cost of capital over here, which boosts the value of fixed assets such as real estate. So when the cost of capital goes down, fixed asset values go up. And that, in the case of real estate, in the earlier part of the last decade, is what contributed to the housing bubble. There is a connection between what we have been doing with Asia and the housing bubble in the United States. That drove up the cost of housing in the United States, which, of course, is still going through a very, very prolonged adjustment, which continues and will continue for many years to come. Meanwhile, population and debt growth outpaced tax revenue collections in many countries. We'll definitely understand that if we think about the population growth rates over in Spain relative to the debt problem and the unemployment problems in a nation like Spain. Lower-level jobs are very sensitive to inflation and taxes, as they were in the United States when they got offshored and outsourced and thrown right out of the country during the inflationary outbreaks of the 1970s. Just look at what happened to the textiles industry in the United States as a result of inflation in the 1970s. By the mid-1980s, the industry was collapsing and was being shoved outside of the United States very, very rapidly into the Caribbean, Central America, and Mexico, and then from there significantly into Asia. So the connections between all of these start to help us to understand that a global labor crisis is very much coming into focus. Continuing on slide number 11, many lower-level manufacturing jobs, unfortunately, they convey difficult work and living conditions. Some workers in China are not sure if they want to even continue farming or work in a lower-level factory job. Some of them, when they do their jobs seasonally at a factory, they'll go back to their farms, and then they don't come back for the seasonal factory type of job because the conditions are, in their opinion, really not much better. Certainly the farm condition is extremely difficult, but the argument is that in some of the lower-level factory jobs in China, for example, it is so difficult, so many hours, so isolating and repetitive that it has actually made the farming economy, relatively speaking, a little bit more attractive than somebody thought it would be. So the China labor lesson is very compelling. Over time, fewer workers may want to do those jobs. That's the key thing on slide number 11 in the lower right-hand corner, that the China labor situation is the key to the argument. Over time, it's possible that fewer workers will want to do these jobs. And then if you take it to its final conclusion, nobody's going to want to do them for long. Now, nations with debt problems need more low-level jobs, but they can't subsidize them. So there is a connection between sovereign debt problems and having a sufficient amount of manufacturing labor to export things in order to drive the revenues to pay for the sovereign debt issuance. Not a pretty picture. Slide number 12. Now we've got the qualitative argument pretty much set up for what is unfortunately a dreary situation. Let's focus on the USA for a few minutes here and really get into some of the more quantitative characteristics of what's going on here, the largest consumer goods market on the planet. Let's take a look, for example, at a survey from Big Research LLC, which, by the way, is the official exclusive research provider to the National Retail Federation. So when the National Retail Federation says anything about, let's say, Black Friday sales or their estimates for holiday retail sales, the research for that was done by Big Research LLC. Looking at responses from an average of about 8,600 a month, the question that was posed, and which we'll look at the answers, regarding the U.S. employment environment over the next 6 months, you would think there will be more, the same, or fewer layoffs than at present. So we're going to take a look at their answers regarding the margins, which are more and fewer. Take a look at the black line. It tends to have less volatility, and interestingly, the levels of the answer are pretty much the same as they were during the recovery period of 2004. It's also very interesting that those who have the more positive response to the question, which would be those who say fewer, also happen to have better attitudes in their answer when the crisis was already rather bad, which would have been by the summer of 2009. At the same time, you can see much greater volatility in how those who said more layoffs than at present, which is a negative response, significant volatility, including a spike right there in late 2005 in response to the Hurricane Katrina, gasoline price inflation, and all of the scare associated with Hurricane Katrina. We've seen this come up in many time series. Moving forward on the time horizon, you can see significant volatility. However, their attitudes about layoffs, it has improved very, very nicely in recent months. And in the United States, generally speaking, there is a little bit less fear than there has been. In other surveys that we've looked at regarding the economy and labor, I would say that those reveal that some fear is more elevated, but this specific question suggests that fear is quieting down a little bit in the United States. Moving to slide number 14, looking at the monthly non-farm payrolls, which is what we call the job report. Taking a look at government jobs would be the green and gray bars. Green would be positive, and the columns with the negative in gray would be associated with the green. Those are the government jobs. And of course, the rather big spike over there on the right-hand side. I'm going to attempt to turn on my little highlighter over here and see if I can make some little indications. There we go. And blue is not that bad, so we'll go with the blue color. The green columns over there represent growth in government jobs, especially associated with the Census Bureau workers for Census 2010. The gray columns over here are associated with the termination of those jobs and with the state budget crises occurring nationally, resulting in the destruction of government jobs at the federal and state level, especially at the state level. Meanwhile, the private sector is slowly beginning to create jobs again. The job creation rate is very, very modest compared to the level of job destruction that we see through this enormous outbreak over here, which will have historical context in just a second. We believe that job creation in the United States is now underway in a rather moderate form, and it will not be sufficient to absorb all of the excess labor in the United States, thus leading to labor malabsorption for the foreseeable future. I'm going to see if I can erase these little items over here while we move forward. On slide number 15, Going all the way back to 1939 to October of 2010, you can see over here on the far right-hand side that just visually we can see the scale and weight of the job destruction cycle that just took place. More importantly for this argument, however, is to understand what do all these cycles mean over time. And the most important event is right in there in the early 1980s. It was in that period that the deficit funding model came into focus under the Reagan administration, using Japan primarily as the mechanism to purchase U.S. Treasury debt, which is how we paid for the tax breaks, which helped for the economy to grow in that form right there. So the economic growth was subsidized through the issuance of more Treasury debt, which enabled us to reduce taxes enormously locally, thus creating some of that borderless economic model that I discussed earlier, and that is fully explained by the economic growth in the 1980s, and then the naturally occurring recession right in there, which was S&L and the Persian Gulf War, with oil inflation and credit-related problems resulting from the S&L banking crisis. Immediately afterwards, you have a continuance of different kinds of foreign debt financing in the Clinton administration in this period in the 90s, characterized by excellent economic conditions, massive labor absorption, the best job market that the country ever saw, and all of that, of course, led into the first major crisis right there in early 2000s associated with the technology meltdown and the additional offshoring of more manufacturing from the United States, setting everything up for the next and greatest crisis right here, which of course changes the entire paradigm. Let me please erase all of those drawings while we move to the next slide. Zeroing in on this a little bit more, it was during the tech manufacturing crisis in the early part of the last decade that enough manufacturing jobs were destroyed and lost, and some software jobs were offshored as well, that the growth in employment and job creation was dominated to a degree by construction-related things in real estate and financial services jobs associated with mortgage formation and financing and packaging and reselling structured products associated with real estate. All of that kind of concealed what was an enormous problem waiting to happen, which was this event right there, which of course we all understand today, and we're living in the aftermath of that. Let's take a further look at specifically what's happening inside of that event. On slide number 17, let's take a look at the weekly jobless claims. Here's the job destruction cycle over here. Weekly jobless claims for new unemployment insurance benefits when a contract expires, when a temporary job expires, when a salaried benefited job is lost for whatever reason. Typically there will be a claim for unemployment insurance. During the job destruction cycle, you can see an enormous outbreak over here. There are seasonal factors as well, which were typical. And then every November, and especially December and early January, there is always a big uptick in jobless claims. That will be the case this year as well, although the situation is improving. So if we take a look at the job destruction cycle from November of 2008 all the way through the week ended November 20th of 2010, we can see that this is approximately where we were at November and December last year, and this is where we are right now. So the threshold is lower, part of the reason why it's more elevated than it was in years past. All of this data is not seasonally adjusted. We work only from the unadjusted data series. We never work on weekly claims from the seasonally adjusted number. The reason why the level is relatively higher than it would be historically, which we'll see in just a second, is because the labor market is structurally different and now includes more contract and 1099s and temporary assignments. So the creation of long-term salaried benefited jobs is not returning to its normal structure, and that means that you have an economy that's always going to have a relatively elevated level of weekly jobless claims. It doesn't mean that we're going through a new round of job destruction, but it does mean that the structure has changed. Looking at slide number 18, this is the percentage change in weekly jobless claims from the beginning of the credit crisis, June 30th of 2007. Again, not seasonally adjusted. And inside of this orange parameter here is our comfort zone for the percentage change to be anywhere between 25 to 50%. Anything above that is a little bit uncomfortable in our estimates, and recently in the seasonal uptick we are seeing some outbreak of more than 50% against that initial starting point of June 30th, 2007. You can see very specifically the job destruction cycle right there with seasonal effects as well, and an additional outbreak of seasonal job destruction right here. Comparing this to a normal cycle such as 2004 in the United States, again, you can see the normal seasonal flow to the upside. The orange line is 2010. The blue line is 2004, which would be a normal job creation cycle. You can see even back then, typical seasonal effects during the summer and then during the winter. Those are normal. This is completely normal. So we're running typically about 125 to 150,000 new jobless claims every week above where we were in 2004 because the structure of labor in the United States has changed. Moving right along, long-term benefits have played an enormous role. There are two major programs that we monitored, the Federal State Extended Benefits Package, which is called the EB, and then there's the EUC 2008 program, which was one of what's called an emergency unemployment compensation package. Those have been done before in previous recessions. This one was cranked out in 2008, and therefore it's EUC 2008. Combined, you've got a lot of people in long-term unemployment, and we're going to see in a second that the majority of this is really coming from the construction collapse. Here's the total program details on slide number 21. I believe all of you will have access to this through TradeStone, and therefore the data here is available to you for reference. But you can see there's a total of about 8.5 million persons as of November 6th using long-term unemployment insurance benefits. The two long-term unemployment insurance benefit packages represent about 4.7 million persons, which is about 55% of the total. It's not hard to figure out where a lot of that is coming from. Employment in construction, which represents a lot of individuals who are working in fields where you don't have to have a lot of special qualifications to work in construction. Yes, you do have to have, skills to do the job, but they certainly don't translate easily into other things. From the peak employment in construction in September of 2006, we can see that there are approximately 3,218,000 fewer employed in construction, a decline of about 26%. If we take a look back at slide number 21, the two long-term packages contain about 4.7 million, and then there's about 3.2 million. That helps us to understand that quite a bit of what we're seeing in long-term unemployment in the United States is construction-related. Furthermore, to understand the employment crisis in the United States, all we have to do is go to slide number 23 and look at the following table. Unemployment based on education is a fascinating breakout. Looking at October 2010 on the far right-hand side of the table, you can see that bachelor's degree and higher, the unemployment rate is only 4.5%. So the vast majority of those with qualifications are employed not only now, but they were rather fully employed even a year ago, and the data that I have on this historically suggests the same, that even during the worst of the crisis, those that had qualifications typically were almost fully employed. Compare that to those with high school diplomas and less, the situation is extremely dangerous. The employment population ratios, which tells us about utilization and absorption, is extremely low. Over here, anything above 70% is good. That's where it should be. Now, the key point to make is that for those with bachelor's degrees and higher, you've got about 46 million in that pool. Take these two, put them together, high school diplomas and less, you've got about 52 million, which of course is quite a bit more than those with the bachelor's degrees and higher. Therefore, you have a drag on the economy coming from this combination right here. So you've got about 52 million where the unemployment rate on a weighted basis is twice what it is for this pool over here. That's the problem in retailing and why retail sales are more difficult today to forecast and why promotional incentives are generally more aggressive than they used to be, thus explaining one of the reasons why Walmart would do so much free shipping for the key period of the holiday season. They are very exposed to this audience right there. Moving right along, that's the situation in the United States. And the data in the United States is very rich and gives us a lot to work from. And I felt that it was important for us to talk about the situation in the U.S. before turning to the rest of our story. Looking at the United States job analysis like that also helps us to understand more fully the connection between promotional incentives, price promotion volume in the U.S., and the job market, and why you have continuing pressure in the moderate market in the U.S. It also is indicative of what may slowly be unfolding in other consumer markets outside of the United States. All of that being said, let's move along to tax revenues and debt and whether we can find a new equilibrium. This is what I mentioned earlier, the concern about the United States of America and the issuance of debt, national debt, and total tax collections. Ordinarily, you should have some sort of a gap between total tax collections and the issuance of national debt. Using a two-axis scale like this helps to represent it. It can be rendered in a table form with a spread as well, which we'll take a look at in just a second. Ordinarily, there should be a spread between these two numbers, and instead, starting in the crisis, they now overlap each other and have flipped positions. I'm going to erase these markings. We really don't want to have a situation like that at all. In fact, I'm getting so excited about it that I'm switching my highlighter color to red. In other words, that is not good. So that's what's happening over here. And I can tell you that that is what is starting to spread globally, and that's why the subject of Forex, sovereign debt, tax collections, and labor is closing the circle and making a connection between the international sovereign debt crisis and the outlook for labor globally and what that may mean for unit prices going forward. Right here we have a highly dysfunctional situation. Let's take another look at that. Total tax collections as a percentage of total national debt. And look at where we are over here. For years we had a relatively smooth thing. Everything was fine. And then the crisis hits, and look at where we are now. We've gapped down dramatically from this starting point in the observation to where we are right over here is a decline of 35%. So while the number over here, nominally tax collections as a percentage of total national debt was a relatively small number, the decline is what we need to be concerned about. The question is, how do we get this back up there? Well, there's, obviously a few ways of doing that, all of which involve two independent variables with some other formulas that we don't need to do here and which I may not even know how to do anyway. In any case, intuitively, I think we can all figure it out. Taxes will go up in order to push this number back up to this level here, or even better over here, or we can decrease how much debt we sell. It's unlikely that that's going to be easy to do anytime in the near future, but the pressure from the new austerity suggests that both of them are going to happen. Taking a look at slide number 27, let's take a look at the unemployment rates outside of the United States from the OECD data. Spain is a time bomb. Spain has an enormous banking crisis associated with real estate, and it has a sovereign debt issuance problem as well. The cost of issuing new sovereign debt in Spain is going through the roof. That's not good. Unemployment, as of a few months ago, I chose to use the June 2010 data because it was the most complete data set. The more recent months were not complete for every country, and I wanted to include every country in the OECD database. If we take a look at Spain, I highlighted Spain, Ireland, and Greece because these are all the biggest focus of the sovereign debt crisis as of right now. The unemployment rates suggest to me that the ability of a nation like Spain with that kind of unemployment to generate the tax collections necessary to really do the kind of austerity to reduce the amount of debt that they'll have to issue in the future, none of it fits together in a nice formula. Basically speaking, they're not alone. Eastern Europe, Ireland, Greece, the unemployment rates are significantly high. Then we've got Portugal, which is a smaller case, but has the same characteristics. Turkey has a strong economy with high unemployment, and they happen to be a member of the OECD, which makes them a little bit of an exception economically and in the database. Turkey is an anomaly in many ways. Globally, they are really unique. The unemployment rate there really is very structurally different from what you've got going on in Portugal and Latvia and Spain. Going down here, you can see why everyone wants to move to Scandinavia. Nobody except me wants to move to Japan. If you want me to move to Japan, I'm always ready to go. I think that it looks like a very interesting place. And then somewhere buried in here are places like the United States and the United Kingdom that have enormous debt problems, but where the unemployment rates are relatively lower. All of this suggests that everybody in that chunk of territory from basically there to the right, I would be a little bit concerned about how much debt they're going to be able to sell into the future and how all of the workers in those countries will feel as the new austerity spreads. When's the last time you saw people in Dublin mobbed into the street demonstrating? It's been, I think it was the last time was in maybe the 1950s that they had things like that. In any case, we're starting to see labor hitting the streets in a lot of countries. Labor unrest is spreading globally. It is a big deal. Labor unrest. Here are some interesting anecdotal stories from the recent news. Slide number 29. This one from a story in AlJazeera.net in July. The China strike wave continues. Quote, China's first generation of migrant factory workers managed to send a little money home to their families in the country's hinterlands despite their low wages. But the young workers of today say that rising inflation and soaring housing prices make basic survival difficult and remittances are a luxury they cannot afford, end quote. Quote, there is no way to see the future with the wage we are making. Living and working like this, my life has no direction, end quote, said Zheng, a 22-year-old welder who works at a factory.
We apologize for the continued technical difficulties. We'll be back with you in just a moment.
Alan, do you think we're back? Alan, do you believe we're back? Alan, do we have a status?
Yes, it looks like you're back.
Okay. So we're back on slide 29, and here we can see a specific story. It looks like we do have a little bit of, I'm going to see if I can resolve a few things over here. Bear with me 1 second. Alan, do we look like we're okay from your side?
Yes, we're fine. I think you can continue. Thank you.
Okay. There we go. I think things are settling down, I hope. But anyway, there's a story from somebody who works at a factory making exhaust systems for a big industrial company. He said, I dream of one day buying a car or an apartment, but with the salary I'm making now, I will never succeed. This is what's happening in China. All you have to do is have one of many different instances. The anecdotal comment here is very, very insightful. From the China Labor Bulletin in April of 2010 in a working paper that they published called The Hard Road. We're a group of migrant workers from the Daoji township of Naiyang city of Hunan, and we worked for several years in underground pile blasting works. And as a result of the dust exposure and the pneumatic drilling stage, we're all suffering in different degrees from occupational pneumoconiosis. The impact of the disease has been severe. It's already caused the deaths of 15 of us. 10 more are no longer able to work in any capacity, et cetera, et cetera. We have grown increasingly indebted, and our lives have become very hard, end quote. This is not an isolated situation. When you outsource lower-level manufacturing and mineral extraction kind of things, this is what starts to happen. So if you have austerity, you have inflation, those workers are very sensitive to any inflation. They cannot have any inflation at all. Since we know that inflation is starting to create problems in China, and we can see these anecdotal stories about what's going on in China, that's not a good situation at all. Slide number 31, it is not unique to Asia even, where you've got a strategically valuable objective like precious metals. You've got mining and minerals extraction associated with gold, and you have similar problems down in South Africa. This story from November in the Times of Johannesburg tells the same thing, that there's labor unrest down there. Obviously, in all of these situations, workers are aware that they are strategically critical to doing what they do, and they are demanding that conditions improve. The bottom line is that they know what's going on, and they're not happy. So if we have a little bit of inflation because of too much debt issued and because of more and more difficulty in manipulating currency relationships and keeping them in narrow kinds of movements, then you have a volatile situation where workers globally are going to have relatively difficult working conditions concurrent to being very exposed to inflation. That takes us into the final part, which is probably the most disturbing part, and that has to do with the population debt crisis globally. On slide number 33, the amount of debt issued by the United States, and all of those are big numbers. That's not $34,000. Total debt issued between 96 and 2009 was about $318 trillion. The percentage change from 1996 to 2009 was about 183%. The world population at the same time from 1996 looks like it went up about 17%. So let me see if I can figure this out. The amount of debt that we're selling goes up about 183%, and then the population of the planet goes up by 17%. That doesn't sound good. Slide number 34, total U.S. debt per capita globally. So you take total U.S. debt, and then you throw it at the global population, and you ask yourself the question, how much debt is everybody on the planet really holding that's just U.S. debt? This is not even everybody else. So you've got about $5,145 per capita globally, and then that's been up about 142% from 1996. Then you've got the U.S. population, which last year was about 307 million. U.S. debt issued per capita in the United States would come out to about $113,000 per person, which went up by a similar amount from 1996. You can see plainly and simply that the relationship between population and debt is not going to work. Therefore, the new austerity is a natural outgrowth of the severe disequilibrium between population growth and debt growth. That being said, we are now living in a new paradigm. Slide number 35 is some tables regarding municipal and treasury debt, and I'm not going to spend any time. We'll leave that as reference. So that takes us into the concluding parts of this rather disturbing conversation that I think we all need to look at. I know from my conference appearances that people are very interested in the subject. There is significant interest in what's going on, and things are changing. So let's see if we can summarize these qualitative observations. We've definitely got an emerging market out there for higher costs. The crisis suggests we have passed the threshold towards higher unit costs, and China remains a source of productivity and disinflation, but these contributions are slowly being offset by global sovereign debt overload. As these imbalances evolve, global labor is becoming sensitive to diminishing returns and diminishing purchasing power. Global supply chains face significant consolidation, which will probably lead to persistent malabsorption of excess labor. So the solution to rising costs will probably be industry consolidation, since larger firms have better economies of scale, which in turn reduce unit cost inflation. Consolidation will very likely prevent a solution to the global unemployment situation we tend to think. The solutions, therefore, come from product innovation and from labor relations innovation. The innovations in management from the 1980s in the United States could provide one example of how global labor should be managed, and then firms across global supply chains must simultaneously consider better product innovation cycles in order to offset faster rates of inflation. So the faster product cycles tend to offset the faster rates of growth in costs, thus stabilizing profits over long periods. Those are the concluding thoughts. Please stay in touch and send your invites to LinkedIn, where I will be very happy to connect with you, and you can follow me on Twitter occasionally. I do make some little comments there as well. I'm going to turn it back to Alan, and I thank you for your participation, and I look forward to all of your questions right now.
Richard, thank you so very much. As always, there's so much to be talked about and so much great information. And I apologize to those of you, some of you were getting some technical difficulties, and I'm sorry for the bumpiness of the ride. I have a few closing comments to talk about from a practical implementation perspective, and then we'll open it up to discuss your questions. I was struck by Richard's closing comments about higher costs, the global supply chain consolidation, and the drive for innovation, because we're already seeing, as a provider of technology and services to retailers in their supply chain, we're seeing that there is an emerging desire on both the parts of suppliers to be choosier about the retailers with whom they work, and retailers in turn looking to create a very different kind of relationship with their suppliers, whether you want to call them preferred relationships or more collaborative relationships. The trick seems to revolve around finding a new way of doing business in this current climate. As Richard points out, it is not a particularly cheerful thought. It is certainly sobering, and if for some reason it carries with it a greater sense of foreboding, at least from my semi-educated perspective, than even something like a material shortage does, because one can always shift to materials. It's always a little bit more difficult when there is such an interconnected labor market around the world that truly is borderless, as Richard says, that it's very difficult to find sort of a way through. So from the TradeStone perspective, look, this is not a problem that came about overnight. It's not a solution that has a 5-bullet point answer to it. I think it comes down to collaboration, it comes down to forecasting, and it comes down to better planning, all of which really is in the service of mitigating risk. And if you think about it, those of you who are on this call today, whether you are retailers, whether you are suppliers to retailers or manufacturers, or whether you are consultants or analysts, your role is to find better ways to plan and therefore respond to the market challenges that you've got. I'm happy to say that we do, in our modest way, have a tool set that is really focused around this concept of risk management, and that's really what our concept of merchandise lifecycle management is all about. So if we take a look at some of the practical impacts of what Richard has been talking about, they seem fairly clear. I think there are a lot of moving parts to this problem, and with any shortage, whether it's materials or labor, it becomes a matter of managing imbalance and instability. So that means as a manufacturer or retailer, if you design product, you're going to have to take into account supply chain realities much more than perhaps you did 10 years ago. Capacity is absolutely not a sure thing anymore, with supply chains consolidating, with the vendor, retailer, manufacturer balance of power shifting somewhat. There is going to be more collaboration, trading off, and quite possibly higher costs involved. Transportation trade-offs will have to be considered, and working closely with those up and downstream in your supply chain are going to be critical for your success. Now that means that really internal to your organization, everyone in that design to delivery process will have constraints in one way or another, writ large or writ small. Managing purchase orders will become a greater problem than they already are, and from what we hear on a daily basis, that's already a challenge. Scheduling becomes problematic, and the bottom line is that anyone involved in this discussion needs to not only have their core plan A, but there also needs to be a plan B, and for the smart ones, a plan C and D, and maybe E and F as well, to make sure that you're able to meet your revenue and corporate goals, and most importantly, when all is said and done, to be able to satisfy the needs of your customers. So from a conceptual perspective, one of the things that we believe we can bring to the party, and I apologize a bit in advance for this very brief commercial, and then we'll get on to the questions. I think it really starts with making sure that you and your partners understand the space that you're operating in. I think you need then, as we have, to have a unifying element that ties together all of the aspects of that design to delivery process, because you are going to be shifting between and planning around domestic and global sources. You're going to be shifting as capacity shifts, as labor makes itself available or opportunities present themselves. You're going to need to understand a model that is something that streamlines your operations, because labor is going to be an increasing component. So you're going to need to be able to react quickly without doing damage to the business. So if you look at it conceptually, it's really all about unifying your processes. It's about bringing domestic and global sourcing together. It's about looking at both your private label goods, if you have them, and branded merchandise, because you may at the last minute have to shift from one to the other to fill a color hole or size gaps or even merchandise type gaps because of capacity or labor issues. The whole idea, therefore, is to have a single version of the truth that enables you to make intelligent decisions. Collaboration cannot be stressed, especially in these difficult times. It's upstream and downstream relationships. It's much less adversarial than the traditional buyer's office pounding the fist on the table environment that so often happens in these negotiations. It's about making an environment that's easy enough for your suppliers to work with you as a retailer, and it's a simple matter of making sure that you as a vendor are easy to do business with as a retailer so that you can start to bring those relationships together. It's about tying the design people into the rest of your supply chain process, blending, if you will, art and science, in order to make sure that you have the best possible chance to source, to absorb capacity, to identify opportunity, and to react quickly. And obviously, automation is an important part of that aspect, especially if you have to do what-if analysis, if you have to look at the impact of pre-positioning and shifting from one resource to another halfway around the world. From our perspective, that itself points to a much more strategic direction of transformation, because we believe just as there is an underlying and fundamental change in the labor market, we believe very strongly that the retail winners in the next 5 to 10 years and their suppliers will be those who have transformed their business such that they're able to empower strategic initiatives, are able to be agile and responsive, and who are able to create collaborative relationships that have very tangible financial improvement. We believe that's critical to performance. Now, we believe that we provide a platform that makes that all possible. I encourage you to learn more by contacting us at info@tradestonesoftware.com or visiting our website, www.tradestonesoftware.com/resources. Either way, I think we have a very strong story to tell about how we can overlay your existing organization, help you mitigate risk, and more importantly, help you to manage as aggressively and as effectively as possible these various crises, challenges, and shifts in, if you will, paradigm that we're coming across now, whether that's shift in materials or whether that is a problem set revolving around labor and capacity and supply chain resources disappearing. So with that in mind, I'd like to open it up to questions. We have quite a number of very interesting ones. We have about 10 minutes for Q&A. One of the questions that came in, Richard, is to you. You made a comment earlier in the presentation around China being in some ways a bit of an anomaly in terms of its capacity and the situation of it being a low-cost, a stable low-cost producer. Right. Are there other areas that you see potentially globally, whether that's in the subcontinent, whether that's in Southeast Asia, or other areas that we may not have thought of yet, that could emerge to become some kind of a labor federation that may be able to pick up some of that slack?
Some of that federation characteristic seems to exist in East Asia, Southeast to Eastern Asia already. But the China phenomenon really does appear to be a once in a very long time type of event. The motivation of the population, the dexterity regarding language, the dexterity regarding different kinds of numerical and abstract problems, it combined with the population that was available to apply these capabilities in enormous numbers, the rapid evolution from farming levels of lifestyles to manufacturing, and then ascension rapidly from farming and agriculture to relatively cosmopolitan middle-class conditions. All of that seems to be rather unique, and I doubt that Southern Asia has the same types of characteristics ready to go. Some populations, for potentially good reasons as well as cultural reasons, may not be in that number of people as motivated to go through that kind of a hardship and transition as seemed to be very much the case in China. You do get some of this in Southeast Asia. All of that is pretty much up and running. There's a few pockets like Vietnam where the capability is also very high, the motivation is very high, but the population available to deploy to manufacturing on many different levels is much, much smaller. the scale of activity there is not going to be sufficient to offset what China was capable of doing in great volume. So the volume problem associated with China probably cannot be replicated anywhere else. Again, Africa is evolving and changing, but it's a much slower process, and you're still years away. And then, long term, you have language problems because of the unknown whether we're going to be able to get the transition to some of the different kinds of language things that in China, for some strange, unique reason to China, just did not turn out to be an impediment to doing all of what they did. I don't think that that's as simple. I mean, generally speaking, if you look at the experience of people coming to the United States and having to learn English, it's not easy. And that creates its own set of impediments, and for some reason, over there in China, it was not as much of a problem. Maybe population kind of obscures some of it, and there were many others who were having problems with English anyway. That's a possibility, but that does not seem to be the case. So I do think it's a once in a century at least type of event.
Richard, thank you. We have an interesting question here. I almost hesitate because it could go down a horribly political path. But it was an interesting question in terms of the U.S. current immigration policy. Obviously, in the face of relatively high unemployment compared to the last 10 or 15 years, is there a mitigating factor if the U.S. were to open its immigration policy up, or if the government were able to get its act together, so to speak, in terms of dealing with the 11 million or so immigrants here, illegally or otherwise, who might be able to be put to work in some of these environments? Or is that just a non-factor in this situation?
I think the problem over here is the cost of labor in any case, and just the bureaucratic legal obstacles to doing things with labor in the United States. It's just not an easy situation, whereas in other countries it's a lot easier to take something and just start to get it up and running when it comes to labor relations, and then to fix things as you go. Over here, the opportunity of doing something with illegal immigrants is there, but then as soon as you convert it into a more normalized type of labor utilization, the cost of labor per unit produced of what type of product would be infinitely more expensive than what you're doing in Asia. And over there, in terms of population available to do that work and the motivation to do it, which of course we can see from the anecdotal things and from all the news reports that we're hearing about and from what we're hearing about of people at the ground level in China, the motivation is deteriorating, the enthusiasm is deteriorating, the hardships are starting to become pretty recognizable as, this is pretty rough and I don't see, where I'm going. Over here, there's still a little bit of social mobility. You do have the sense that if you work hard and kind of figure things out that you can kind of better yourself. It's still, there is a little bit of, the dynamic thing is still here. It's not as good as it used to be. It's been damaged. But what I would do is answer the question by saying that what we could do with, let's say, 15 million people, in terms of volume, that starts to not be a big number compared to Asia. And then in terms of unit labor costs, starts to become just pathetic compared to what they're able to do over there.
Great, thanks. I think we have time for two quick questions. A number of our listeners or attendees noticed that your employment model looked a bit like a sawtooth function, if you will. It's kind of boom or bust. Is that something that you think is an artifact of the market, or is that something that may change over time?
I think I really love that observation. I think I haven't thought of it, and I think that's really neat. Whoever came up with that, it's a really fun way of looking at those charts. And I think the person might be thinking about, especially the non-farm payrolls chart from 1939 to 2010. And you can really see using that as a talking platform that you have all these different periods during which there were different funding systems, and the different funding systems had their origin in different kinds of trade relationships with other countries, with different kinds of tax situations, and then what kind of solutions and remedies were possible in order to put an end to one set of problems in order to get out of a recession and then to get things going, and then what kind of new problems did it create over time. And you can really see that when you start to come into the 2001, 2002 crisis and where everything went right after that, leading into just the unbelievable demolition of labor in the United States, which is a permanent form of damage. Some of it is not resolvable. All of that being said, I may have lost track of the original question, Alan, so I'm going to ask you to kind of get me back on track. But what I notice in the sawtooth or that irregular pattern over time, the boom-bust cycle, some of it is natural, but I would say that it's mostly man-made in its severity. In other words, there's a natural cyclicality that seems to be inevitable naturally, but then there's more of the true boom-bust factor that's absolutely man-made and concocted by the influence of politics and the influence of mass behavior, mass psychology, and then especially post-World War II, the ability to do the borderless international system, which is what we've had going into the current crisis and which is being tested to its severity at its extreme right now in the sovereign debt crisis. So I would say that the paradigm that has prevailed for many years of countries selling sovereign debt to each other against an attempt of having a borderless economic system, I don't know if it's going to continue to work, and that raises the question of more labor unrest and unhappiness globally with the borderless international system.
Great. Thank you so much, Richard. I'm afraid with that question, we've come to the end of our time. Richard, Mr. Hastings, I want to thank you again for your time and really tremendous insight. I know I speak for the folks on this webinar and all of us at TradeStone. We appreciate your thoughts and insights. To those of you who have attended, I hope you found it useful and educational experience. We remind you that on December 15th, we'll be running the third in our series on look back on 2010 in the retail market and a look forward into 2011. And final reminder that a copy of this webinar will be available shortly on our website. And for those of you who have attended, we'll be sending out a link to that so that you can bypass the registration process. So thank you again for your attendance. If any questions pop up, feel free to send them to info@tradestonesoftware.com, and we'll make sure that we either get them to Richard or answer them ourselves. Thanks again for joining us on our Global Issues webinar, and we'll look forward to having you on our next event. Take care, everyone.